The candle range theory, CRT, is effective because it relies on the power of three candles, each with its own purpose in the market. The first candle represents accumulation. This is where the market gathers liquidity and builds the foundation for the next move. The second candle represents manipulation. Price sweeps liquidity, often tricking traders into entering in the wrong direction. The third candle represents distribution. This is the real move, where price reveals its true intention. However, not every setup is valid. For a candle range theory setup to be valid, the candle sweeping liquidity must close with a wick below or above the liquidity area. If the candle closes strongly beyond the level without a wick, the setup is invalid. Always look for wick confirmation to identify a valid CRT model. Now, let's talk about applying CRT on higher timeframes. Each candle shows a range, and every range has its purpose. On the 4-hour chart, especially around demand and supply zones, candle range theory becomes very powerful. Pay attention to 4-hour candles that form at specific times of the day: 1 a.m., 5 a.m., and 9 a.m. Eastern Standard Time. Here is the process. Wait for the second candle to break the high or low of the first candle, and then close back inside the first candle's range. Once this happens, you can refine your entry on a lower time frame to maximize trade precision. The 1-hour time frame is also an excellent place to look for trades, especially between 1 a.m. and 3 a.m. This is when liquidity is usually accumulated and manipulated before the true move begins. By understanding this structure, you can recognize market manipulation, time your entries more effectively, and trade with greater confidence.